Hi, good morning, students, and welcome to our Saturday morning session of performance management. Sorry about the few minutes late start, but, and a matter unrelated to classes just suddenly cropped up. Now, the agenda for today is this. Um, or before I give you the agenda, I trust that in the time when there were no classes, you had the opportunity to go through the stuff which was previously done and certainly would have come up to date and at this point been fully up to date in your studies as far as what was done. Now, as I indicated to you, we'll have to put in some makeup classes. The makeup classes will be on Mondays. I think I had sent you the original WhatsApp message. So our first makeup class would be on Monday coming. Now, of course, this would only be for a few sessions, the sessions which we lost. Our Saturday morning sessions will continue Saturday morning, but these few sessions will be simply makeup sessions. So as I said, these would just be a few on the Monday. It would not be a continuing thing on the Monday. Okay, it's just to make up for what we lost. If we can pace ourselves properly on Saturday without compromising on the content, then we'll be able to reduce the amount of Mondays. But it all depends on how we go to bring ourselves back to the appropriate point. Now, back to today's session. As I indicated to you, the agenda for today is this. We'll be looking at a further costing method. You may recall that we looked at some previous costing methods, marginal and absorption costing. We did a review of that stuff, which you would have covered in your F2 paper, but which, we went through here. I told you your main concern really in PM, performance management, is the use of activity-based costing and a comparison of ABC with absorption. So you do need to know how to do your absorption calculations, but not the fine types of calculations you would meet in your or you would have met in your F2 management accounting paper in level 1. The examiner will not duplicate what was done there, but he does expect that you are aware of the topic, because if you've got to do a comparison of absorption with ABC, clearly you need to know. As we look at a couple of questions as we go on, you'll see exactly how the examiner can examine absorption costing and activity-based costing at this paper level. So, as I was saying, we went through marginal and absorption. We went through activity-based costing. We looked at something called environmental management accounting. We look at target costing, okay, and so on. So we cover those areas, okay, and those are simply costing methods. And what we are looking at today is a further costing method, okay, which is called. Just hang on a sec, please. Yes. So as I was saying, what we'll be looking at today is something called throughput costing or throughput accounting, which is another form of accounting or costing. Now, it's something which students would not have done at all before. It's something which is specifically done, in this paper in performance management. Indeed, some of the other topics which we looked at before also would not have been done before. Things like target costing, for example, and environmental management accounting, activity-based costing, areas which are initially done in this paper, performance management. So this topic which we are going to look at, which is a continuation of costing methods, is something called throughput costing or throughput accounting. Now, this is a topic which, when a student or if a student attempts to study on their own, the student may become a bit confused, not because it's a difficult topic. That's not the reason for the confusion. The reason is because the student may be unable to actually put the topic into its correct perspective and see it for what it truly is. It's not the easiest thing to do on one's own as a student, okay, and figure it out. So Sorry, the reason why I just muted and unmuted as before is because there was some disturbance taking place, and I didn't want it to come across onto the recording. Yes. So as I was saying, this topic called throughput accounted, studied on one's own is not the easiest topic to follow, not because it's complex or difficult or anything, but because it's a bit difficult for a student to visualize exactly what this is about and form a picture in one's mind as to what throughput costing is about. Now, it actually, the concept of it itself is not brand new. Students would have encountered something like this when they did F2 decision making in a way. Now, I said in a way, and I'll explain why as we get on. Throughput accounting, okay, introduces a slightly different concept from a specific situation you would have met in decision making at level one, okay, dealing with limiting factor situations. You know, it adds a different dimension to it, and this is what we'll be doing. Now, in case you can't remember, in case any student cannot remember um, about what I just mentioned, limiting factor decisions. It's something that we will be looking at in decision making, which hopefully we'll be able to start today as well, because throughput accounting is not a very long topic. So, you know, all that would be cleared up as we go on. You simply need to listen to the recording, to the videos, okay, you know, attempt the questions and whatnot given to you, and you'll be good. So let's take a look at this and see what it is about, and I'll explain, of course, as we go on. Now, what you probably realize, I've stopped sending the handouts before the class, or with the initial login link to the class. There's a reason for that, because as you probably realize, during class I would often add a few notes and whatnot to the handouts to make it easier for a student to follow. And I would have had in the past to send you a second handout after with the updated one with whatever notes, explanatory notes I would have added in class. So that's why I've stopped sending the handouts for any of the papers. So for those of you all who are doing any other papers as well, you would observe, you would have observed the same thing. The handout instead would be coming with the recording link after, of course, the topic has been completed, to ensure that we don't, you know, we don't have to keep duplicating things all over the place, you know. Okay, so um, let's get on with it. Now, as I indicated to you, this is another form of costing, and this is actually the last form of costing that we'll be looking at, along with target costing and you know, marginal and absorption and activity based and environmental management accounting. All those things we looked at. This is the last of the list. Okay, throughput accounting. It's called throughput accounting and the theory of constraints. And again, if you were to look at the name, I did make a statement a few minutes ago where I said a student studying this topic on his or her own may find it a little bit difficult to visualize exactly what it is. The content is not really difficult as long as you understand the concept which which throughput accounting is trying to get across, you know. And this is, of course, what I'll explain to you as we go on. So let's take a look. Now, it is very important that you understand the underlying concepts upon which throughput accounting, okay, is based. Because, and these are very important. If you were to deviate and try to form your own ideas as to what throughput accounting is about, you will go off track. I can assure you of that. It's a fairly specific topic, and the calculations are also fairly specific to throughput accounting. The reason why it's also called the theory of constraints, so actually what I should say is the reason why part of the name added is the theory of constraints is because what it tries to do is to deal with limiting factors. A limiting factor is a constraint. And you would recall a few minutes ago I said in your level one, you would have covered something called limiting factors and how to deal with simple limiting factors under the topic called decision making, you know, where you've got to calculate the contribution per unit of the limiting factor and rank the products and that sort of thing. But those are things which we have to revisit again in decision making in your course. So in that particular topic, which I referred to just now in level 1, the limiting factor, this is really similar in that respect to it, except that the way in which the calculations are done and the figures used in the calculations are different. But the idea of a constraint is the same thing as a limiting factor. In business, a constraint is something which restricts or holds back the business in some way. Now, let's take a external look at this, meaning outside of the topic. You know, for most people, their limiting factor, okay, might be money, and call that their constraint then. So the limiting factor slash constraint might be money, and what logical thinking people would try to do is to maximize the use of their money. In other words, then, assuming that your money is scarce, meaning that you don't have unlimited amounts of it, and meaning also that the things that you need to do calls for more money than what you are getting. So you obviously have to restrain yourself or constrain yourself, okay? And you may do this by devising a budget or something of the sort. But the important thing is you need to maximize the use of your money. You need to, really be careful in that case and not waste money behind things which don't add in any way any value to your life whatsoever. And this, of course, is something which many people do not do. You would hear people often saying, well, they've got cash flow problems. And every time, you hear them say, well, we don't have enough money, or our salary isn't enough, and this sort of thing. And next thing you know, you see them at bars drinking their life away. And while this is not meant to be a lecture on morality or anything, I would often wonder how you would hear people saying that, and then sometimes 3-4 days for the week you see people at bars and pubs and that sort of thing, which is fairly expensive nowadays. So, a rational thinking person will try to limit, okay, their spending and restrict their spending to the really important things. And this is what this theory of constraints is about. It is assumed, as you will see, that in business, the business would normally have some constraint, something which holds it back, for being as profitable as it would like. And it therefore has to maximize the use of this constraint factor. And this is what you will see, and what I will explain further as we, go on into the handout. Now, some of the references on the right there, okay, some of the inserts, the comments, you would see the date is a little bit, back because the handout has been updated, but some of the comments have not been because they still apply. This topic has been examined a number of years now. Nothing has changed in the topic. So exactly how I would have taught this topic 1 year ago, the same facts, basic facts would be taught again, of course, with any different examples and whatnot used to make life a bit more interesting. So it's one of these topics which any student who would have studied F5, as it was called, a year ago, even more than a year ago, would have covered this topic. It has not changed from the syllabus. So let's take a look. Throughput accounting is based on the theory of constraints, which is legally abbreviated as TOC, by the way. Okay, it's an allowed abbreviation. TOC views any company as a system and emphasizes the importance of the constraint. So it emphasizes the importance of the limiting factor, and just as how you would emphasize the importance of your money. A constraint is any factor which restricts the business from increasing its cash flow, since production and sales are restricted. Yeah, so it's as simple as that. A constraint is any factor which restricts the business from increasing its cash flow, since production and sales are restricted. Now, it can be different things. It can be a type of machine hour. It can be a type of labor hour. It can be cash even. But as you would see, as far as this topic is concerned, it's fairly contained. In other words, what you need to study. The theory of constraints is based on the idea that any company has identifiable constraints, and management should identify the most binding constraints and manage them so resources are used more efficiently. Now, in case you're saying to yourself, but we started off by saying the throughput accounting is based on the theory of constraints. And now we are talking about the theory of constraints. So where is throughput accounting? Well, that will be revealed shortly. That opening statement, though, is very factual. I mean, throughput accounting is based on the theory of constraints. So obviously, I have to explain what the theory of constraints is about first, and then bring it back to throughput accounting, which is where we actually get into the calculations and whatnot. So back to this last statement, the theory of constraints, okay, is based on the idea that any company has identifiable constraints, and managers should identify the most binding of them and manage them so resources are used most efficiently. Now, what you would see for this topic, okay, let me just highlight this a bit. Okay. For this topic, there would usually only be one binding constraint, one limiting factor then, because you're not taught in throughput accounting how to deal with several limiting factors at a time. So there'll usually be, in fact, not usually, there will be in your question one limiting factor. The examiner may refer to another constraint, but not for you to include in the calculations when doing throughput accounting and the theory of constraint related calculations. Now, the idea of the theory of constraints, was devised by somebody called Goldrat. That's this person here. But although he developed the idea, okay, the term developed is quite an appropriate term, because the idea of there being a constraint was nothing new. I mean, limiting factors would always have been around. Companies would always have been facing constraints. So if if the handout had read Goldrat, who originated the idea or something like that, that would have been incorrect. What he actually did is he developed the idea, okay, and added his own touch to it. And this, of course, is what we are studying. So the goal is to make money now and in future. Now, what you realize is that throughput accounting and the theory of constraints focuses to a great extent on cash flows. Because if a company has limited cash, it cannot get by. It's as simple as that. It has to have enough cash. So the goal is to make money now and in future. For Goldrat, who developed the idea, the way to make money is to maximize a measure called throughput, whilst minimizing two other measures called inventory and operating expenses. Okay, so now we're getting on into this, okay, this term called throughput. And you've been told the way to make money is to maximize a measure called throughput. And of course, I'll show you what that is shortly, whilst minimizing two other measures called inventory and operating expenses. And of course, I'll explain what those are as well. What you realize is inventory and how inventory is looked at, okay, is not the same as how it would be looked at under normal accounting standard, definitions. I told you throughput accounting has its own way of doing things. And this is another reason why I keep saying that students doing this thing for the first time on their own, they find it a bit difficult to reconcile how they see things with what they need to know from the topic, because it's like that. Even these terms, what is inventory? Inventory is a bit different, and how inventory is seen is a bit different, as I said, from financial accounting. What is operating expense? Even that is a bit different. Now, the theory is quite important because, as you no doubt have realized by now, the examiner in his objective test questions can ask you so many different things. Theory of constraint uses the example of a chain. Now, this example used here Is not my example, it's actually the example used by Goldrat, but I'll explain it. It's quite a good example. Theory of constraint uses the example of a chain and refers to the constraint as the weakest link, since if the chain is pulled, the breaking point is the weakest link. Strengthen any link before the weakest one is a waste of time and resources, since the weakest link determines the maximum performance of the entire chain. If the system performance is to be increased, the constraint must be identified and explored. Now, if it's like this. Let's assume that you've got a team, okay, working on a project, a team of say 5 people working on a project. And you may have experienced this in your workplace, okay? And the effort is required from each of the team members in order to get the job done. 4 of the team members are good. I mean, they pretty much do what they're supposed to do. But one of the team members, call him number 5, okay, is always working behind time. And therefore that now each party has a specific task to perform. And the task which has to be performed by team member number 5 always seems to be running behind time, because team member 5 is a bit lethargic in his approach, okay, to his work. And because of that, the entire project is being held back. Now, because each team member has a specific duty to perform, it makes no sense that the other 4 team members decide to max out their time and try to pull the project forward. Because unless team member number 5 comes up to par, the project is not going to go anywhere, because it is dependent on the input from each team member. So if team member 1, 2, 3, 4 say, you know what, let's kind of make up the slack by working harder on our parts, that makes no sense, because the project, as I keep saying, cannot move forward unless team member number 5 does his part as well. What can be done? Well, the most obvious thing is to get team member number 5 to do what he's supposed to do and bring his work up to par. If team member 5 is unable to do that, okay, then the team, in communication with management, may be forced to remove team member 5 from it and replace him with someone else, because the project is being held back. Now, this is exactly what the concept or theory of constraints is about. Because the example used here with the chain, if there's a weak link in the chain, okay, and of course, if the chain is pulled, the breaking point is the weakest link. So trying to strengthen any other link before trying to do something about the weak link makes no sense at all. The chain will still break. Now, in relation to our business, okay, there are different types of constraints. Although, as I said, this topic as itself is fairly specific as to what are constraints, what is an operating expense, and so forth. Let me just use an example. Let's assume that a company produces 3 products, and each of these products use similar materials and has similar labor requirement, but they are different products. But as I said, they use the same grade of labor, the same type of materials, and so on and so forth. The same machine, capacity, and the same type of machine product output is also required. Now, let's assume that the machine capacity is good. They've got enough machine capacity to produce all the units. They've got enough labor availability to produce all the units. But currently, the material supply is limited. The supplier cannot supply more than a certain amount right now. Now, in that case, the material is the weak link. So clearly trying to work longer hours, that is by the workers, and produce more from the machine makes no sense. Because unless that material problem is sorted out, output cannot be increased beyond a certain level. So the material is limited. If the material cannot be uplifted in the short term, meaning that if more cannot be acquired, then it means the output level provided by the labor and the machine would have to be decreased to match the output level based on the available raw materials. So maybe the organization with the available labor right now and available material, I'm sorry, not material, and available machine can produce up to 10,000 units a month. But because of the limited material availability, only 5,000 units can be produced. Now, clearly, it makes no sense because it's not possible to produce more than 5,000 units because the units all need the materials. And in that case, what the organization should focus on is doing something about the raw material, the supply. Now, what they may do, of course, is talk to their supplier and say, look, we've been held back. And unless you can increase your supply to us, we're going to have to seek alternative sources. We'll still take what we can get from you, but we're going to have to buy the rest outside. And that is an example of strengthening the chain. As the example I use with employee number 5, if employee number 5 cannot come up to par, an example of strengthening the chain would be replacing employee number 5, which is normally the last resort, as you would see. Okay. So this is what the theory of constraints is about. This is what a constraint is about. Now let's move on and see what happens next. So just to read back this, strengthen any link before the weakest one is a waste of time and resources, since the weakest link determines right now the maximum performance. That's like the material required, the limited material just now I used. If the system performance is to be increased, the constraint must be identified and explored. Explored means trying to do something about it. Now, to judge if a company is moving towards its goal, remember you were told here, the goal, okay, is to make money now and in future. And this, of course, will be done by selling more units and whatnot. So to judge if a company is moving towards its goal, theory of constraints has 3 measures giving rise to 3 simple questions. Firstly, how much money is generated by the company? Secondly, how much money is captured/retained by the company? And 3, how much money must be spent to operate the company? Now, while those 3 questions may not mean much to you just by simply reading them, as we go on and look at the measures which are employed by theory of constraint, you'll see exactly what those 3 questions are about. The theory of constraint relies on the use of 3 measures. Now remember, you were told at the start throughput accounting is based on the theory of constraints. So the constraint is the limiting factor. The accounting part is how we account for the limiting factor, how we show the financial consequences of there being a limiting factor. Because of course, accounting involves calculations and figures. The 3 measures of theory of constraint are as follows. Firstly, throughput, the term throughput. Throughput means the rate at which a company generates money through sales less direct materials in the product sold. Now, it is important that you understand that when dealing with, and this is made clear in the handout as we read on, when dealing with throughput and the theory of constraint, material, direct material is held to be the only variable input cost. So just as how, if you remember your basic CVP analysis, which you would have done in F2, but again, which we need to revisit in performance management, And also we met this term when we went through marginal costing. Remember, when we looked at marginal costing, we saw the concept of contribution. And in that lecture, we said that contribution is sales less variable production cost. Yes? And variable production cost would normally include direct materials, direct labor, any direct expenses, and any variable production overhead. So they must all be variable. Of course, a variable cost means a cost which increases proportionately with the increase in output, and vice versa, which decreases proportionately in relation to decreases in output. So with throughput accounted and the term throughput, it is assumed that the only variable cost is direct material. In fact, I think I have that noted here for you. See, it is assumed to be the only variable production cost, direct material. And again, that's why, at the risk of repeating myself, I said a few times earlier in the lecture that students doing this on their own may find it a bit difficult, challenging to understand the concepts. Secondly, investment. Again, look at the meaning of the term investment, as you will see this detailed in a few minutes. Investment is all the money the company invests in buying things to sell, the investment in materials and so forth. Investment, again, as you will see shortly, when doing throughput accounting, investment is not investment in plant and equipment and whatnot. And again, therein lies the trouble area for students, because a student would always see investment as being investment in plant and machinery and whatnot. Again, investment, the terms have specific meanings when looking at throughput accounting. So investment is all the money the company invests in buying things to sell, and this would be elaborated upon shortly. Operating expense, all the money the company spends in turning investment into throughput. In other words, turning investment into units which can be sold in, because remember, throughput is the rate at which the company generates money through sales, less direct materials. Now, as you might imagine, then operating expense will include, say, like labor and any machine time. Because all the money that the company would spend, say, for example, paying the workers for them to convert materials into sales. Remember, I told you investment, okay, is not investment in plant and machinery as far as throughput accounting is concerned. Investment is what the money that the company spends in buying things to sell, which would normally be stock. So if, for example, the company is a manufacturing company, the investment would be, say, the investment in materials. And labor, the monies paid to the workers, would be for the workers to convert the raw materials into units which can be sold. And again, therein lies the difference, okay, between the terms here, how you would look at it normally. One other thing you would realize, as far as throughput accounting is concerned, any expense which is categorized as operating expenses are fixed costs. With throughput accounting, as I mentioned a few minutes ago, the only variable cost is assumed to be direct materials. Of course, that is not necessarily so all the time in practice. But again, this is the assumptions upon which throughput accounting, okay, these are the assumptions upon which throughput accounting are based. Throughput, well, you saw up here the rate at which the company, but let's look at it in more detail. Throughput may be defined as all the money that enters the company less what it has paid to vendors. In other words then, okay, if we say throughput is the rate at which the company generates money through sales less direct materials. So sales less direct materials equals throughput. And let's just call that money then. Okay. Now that's the same thing being stated here. All the money that enters the company will be through sales less what it has paid to vendors, that would obviously be the vendors of the materials. So it's really the same thing as up here, but just stated in a slightly different way. This means that the money paid is for materials, and this is money generated by other companies, the companies from whom the materials were bought. So again, the concept, throughput, sales less material costs, revenue less material cost then equals throughput. Not revenue less material, less labor, less any other overheads and so forth. Revenue less materials. Okay, and you will see these in the calculations as we go on. To calculate throughput contribution, now usually rather than simply using the term throughput, although it can be used and it will mean the same thing as throughput contribution. Contribution itself, as I mentioned a few minutes ago, when looked at under marginal costing, is sales less all the variable production costs. To calculate throughput contribution though, material cost is deducted from selling price. And as I've been telling you, this implies that throughput considers the only variable cost is material, with most of the others being fixed, example, labor, etc. So sales less material cost equals throughput contribution. Let's make a note of it here for you. And again, this is why I told you, this is another reason why I told you at the start of today's lecture that I've stopped sending the handouts to you before. I'll be sending them after along with the recording link because of little additions and things I'll be making for explanatory purposes. So let me just do something here. Okay. Okay. Sorry. There's a problem with this external keyboard here. OUTH. Right. Sales less material cost, throughput contribution. Material cost is assumed to be the only variable cost because contribution, remember, is sales less variable cost. It's just that with marginal cost and variable cost include direct material, direct labor, and so on. But with throughput contribution, which is not the same as contribution under marginal costing, it is sales less variable cost as well, except that the variable cost is only made up of materials itself, direct materials. So total throughput contribution sales price take away material cost. The reason why we got outside time sales volume is because the selling prices are $100 and the material cost is $60. The throughput contribution is 40, and 40 times the sales volume, let's say 100 units, 4,000 would be the total throughput contribution. The throughput contribution for one unit, of course, will simply be the selling price less the material cost. But if we need to calculate it in total, of course, we'll simply multiply it by the total amount of units. Now, I mentioned a few minutes ago, investment has a different meaning entirely from the way in which we normally look at investment. Investment represents all of the money used in buying materials from suppliers for inclusion in the final product. Why is it buying materials, etc.? Is because it may be other types of inputs as well, which are also classified as similar to materials. Anything which has to be used to convert into the product itself then. Okay. So investment represents all the materials used in purchasing, all the money, sorry, used in purchasing materials from suppliers for inclusion in the final product. And very important, although I have put it in bold here, okay, I'll just highlight this line for you. Okay, so investment here does not refer to investment in plants and equipment, and that's very important. I can assure you, the examiner, it's very possible that when the examiner tests this in your objective test questions format, he will ask you about what about investment in a question, and of course he may ask it in any of his devious ways. Which of the following represents investment under throughput accounting, something like that. Or he may even hide it around of the, and state it in a sort of negative way. In other words, he may say, which of the following does not represent investment in under throughput accounting. Investments in inventory are valued at material cost alone. Yeah, there's nothing more added on to it. Remember, investment here does not refer to plant and equipment, it refers to money spent in buying materials. And investments in inventory are only valued at material cost. Now, consider this. Therefore, only the unsold direct material cost is included in the form of actual direct materials, work in process, and finished goods. See, what that means is, in your stores department, the investment, let's assume we were doing a balance sheet under throughput accounting. And on the balance sheet, you see investment. Investment here will include any unsold direct materials, work in process, and finished goods. Rather than that, under normal circumstances, normal being normal accounting principles, any remaining stock of direct materials, work in process, and finished goods would be considered as inventory. But as I said, if you were doing a balance sheet, statement of financial position under throughput accounting, which of course you would not be asked to do that, I'm just trying to make a point here, then those items, unsold direct materials, work in process, and finished goods, will be classified as investments. This means no factory overheads. Now that's also important. No factory overheads are carried forward in inventories, leading to false signals that profits have increased via the cost allocation process, as with absorption. Right, now let me explain that. Remember, with absorption costing, a share of factory overheads are included in units produced. Now, some of the units produced may not have been sold. So according to what you read here, okay, they will be categorized as investments, but finished goods, in the balance sheet there. With absorption costing though, some of the finished goods, or in fact the finished goods, would include a share of production overheads, factory overheads. Not so, however, with throughput accounting. Throughput accounting, the only cost which should be included as part or as the variable cost in producing the units, and as part of the product cost in producing the units, will be material costs. No factory overheads or anything. Factory overheads would be treated in a similar way as with marginal costing, i.e. as a fixed cost. Okay. Even direct labor costs are excluded, as these are treated in a similar manner to factory overheads. That's right. I mentioned to you in passing earlier that direct labor costs are actually treated, labor costs are actually treated as fixed costs under throughput accounting. Now, that is not totally unreasonable, because it's more than likely. Now, I'm not saying that it's always the case, but it's very likely that employees nowadays, okay, would be paid, on a fixed basis. When I mean a fixed basis, not based on each unit produced, but based on, say, a rate per hour, a time rate basis. Then, what that means is the employee. Let's assume that the employee is paid um, $20 an hour, and for the week the employee works 10 hours, so that's $200. That means the employee is paid the $200 regardless of what was produced, because he's paid on an hourly basis, not per unit. So in that case, the fixed cost, the labor cost, can be seen as a fixed cost because it does not depend on how many units were produced. Remember, strictly speaking, in costing, a variable cost is one which changes proportionately, okay, in line with changes in output. So all I'm saying here is that the idea and the assumption that labor cost is treated as a fixed cost is not totally unreasonable, okay, and may actually apply under many occasions, okay, in practice. Okay, now let's just summarize before we move on. So you saw throughput itself, throughput contribution is sales minus material cost. You saw investment is investment in materials. We saw that all other costs except the material costs used in the production of the unit, all other costs are assumed to be fixed, with the direct material cost being the only variable cost. That's the reason why throughput contribution is sales minus direct material cost. Again, we saw investment is not investment in plants and equipment. Investment is the investment in materials then. Operating expense, which is the other important term when doing throughput accounting, is taken as the money which must be spent on an ongoing basis to operate the production processes, such as wages, rent, power costs, and so forth. Now that's operating expense. The money which must be spent on an ongoing basis to operate the production processes, and this would include wages, rent, power cost, in fact, it would include just about any other production related cost except direct material. Operating expense simply represents all other items, well, this is what I just said, that did not go into throughput. Because remember, what went into throughput in order to arrive at throughput contribution is materials. So operating expense simply represents all other items that did not go into throughput or into investment and represent the cost of converting the inventory into throughput, which we did mention earlier in the handout. Operating expenses are assumed to be fixed costs. That's very important. Okay, now I will tell you, in case you're saying to yourself at this point, how do we remember all these little things when we always accustomed to seeing these terms used in different ways? Well, you can remember it in a couple of ways. You can remember it just by reading what we've been doing, and of course the explanation. But the easiest way to remember it is, of course, through seeing it in calculations. And this, of course, is what I'll go on to show you shortly. So bear in mind everything we've been saying so far, and don't change it. Don't deviate from it. Don't decide, for example, to call operating expenses variable and fixed. Don't decide to call investment in plant and equipment and whatnot. Don't decide to call contribution under throughput sales less variable cost where all variable costs include direct material, direct labor, direct expenses, and so forth, as with marginal costing. You have to stick strictly to the terms used under throughput accounting. So just reading on, with the three measures, the company knows the impact a decision has on the company's bottom line. The ideal situation is to increase throughput and decrease investment and operating expenses. Well, of course, that makes sense because remember again, throughput, which is throughput contribution, is sales less direct material cost. Now, the bottom line of the company is profit. So what you see in here is the ideal situation is to increase throughput, sell as many units as you can, and at the same time decrease the amount of money spent on materials. In other words, try to acquire the materials as cheap as possible without, of course, compromising on the quality, and try to keep your other operating expenses as low as possible as well. This is nothing new. I mean, this is what businesses, we assume rational businessmen would try to do, increase sales and keep their costs down. Except, of course, the terminology here is a little bit different. So the bottom line is normally seen as the profit, as is usually the case. However, any decision which increases return on investment is a good one. Now, return on investment also has a different meaning when looked at under throughput accounting as compared to the usual use of the term return on investment. For example, up until today, you might have been taught that return on investment for a company is the return made based on the use of the assets employed in. So maybe if you wish to calculate the return on the assets, how much sales was generated, you'll compare sales with the assets. If you wish to determine how much profits was generated from the use of the assets, you'll compare the profits with the assets, because the assets are seen as the investment. But if, as we saw earlier in the handout, investment is investment in materials, clearly return on investment under throughput accounting will not have the same meaning as return on investment under typical accounting, as I just mentioned. It's as simple as that. Investment here has a different meaning, and therefore return on investment must have a different meaning also. So return on investment is throughput, and of course, as I have here, as we've been saying, which is throughput contribution and sales less material cost. That's like contribution then, less operating expenses. So let's assume that the total throughput for a period came to 100,000 and the operating expenses amounted to 60,000. So the throughput, the profit, the return then, the overall return, okay. Remember, throughput is sales less direct materials. So as I said, the contribution, okay, is say 100,000. And the operating expenses total 60,000. So 100 take away 60 is 40, that's the profit, the return then. And if you had to calculate the return on the investment, what you do is you put that over the investment, which is the amount of money this company spends in a period on materials. And again, we'll see this shortly using actual figures. So you see again how different the terms are. And once again, you see why I said it is almost impossible, not impossible, almost impossible for a student doing this topic on his or her own to understand everything that this topic is about, because it's just different, okay? When the company has a constraint, now we related back again to constraints. Remember, we saw earlier what a constraint was. I told you it can be something which limits the company in some way. And remember, I did say, using the example of the materials, if the material is the constraint, the company can only produce a certain amount as the material availability will dictate. If for you cash is your constraint, you can only do things as your cash dictates, and you will try to maximize the use of it. Now, similarly here, when a company has a constraint, the procedure is to find the throughput per unit, the throughput contribution per unit then. So the throughput per unit of the constraint, it could be time, like machine hours, for example, to decide on the optimal production plan. All that means is that the company will try to maximize the use of the scarce resource, to get as much throughput contribution as possible in the light of the scarce resource. However, when the company has more capacity than the market demands, the criterion is that which maximizes throughput. Now, this is a very important paragraph. See, again, it's something like what you would have looked at in your studies in level 1 under limiting factors decision making. If a company has no constraints whatsoever, meaning that there's enough labor time, enough machine time, and all that sort of thing, it can buy as much in materials as it wants and all that. And the question arises, what should be the objective of the company? Well, the objective would be, to just produce as much as possible. Because if you were to produce as much as possible, you will maximize the throughput. Remember, again, throughput is sales less material cost. And throughput profit, the profit then, that's how we would calculate it, as you saw here, would be the sales less material cost, throughput less operating expenses, and operating expenses are assumed to be fixed. So if there are no constraints whatsoever, we will simply produce as much as can be. However, when there is a constraint, as there usually will be when dealing with this topic, the procedure is to find the throughput per unit of constraint, example time, to decide on the optimal plan. Now let's just take a read of this here. This is indeed very like a limiting factor situation in decision making. And as I keep saying, although this is something you would have visited, you would have covered in level 1, it's something again that we look at in detail in this paper when we examine the topic decision making, which is the next topic we'll be looking at. So just read, and this is indeed very like a limiting factor situation in decision making, where in the presence of a limiting factor, the objective is to maximize the contribution per unit of the limiting factor. However, if there are no scarce resources, the goal is to simply maximize contribution because the other costs are assumed to be fixed. Now, you need to understand carefully, what that is about, although we'll see it in the calculation, and also, although as I keep saying, you may have touched on it in your level 1. Let us assume, that, all right, let me use an example here. Let's go to the spreadsheet, and I just use an example. Now, the example I'll be using is what typical of a situation you would have met in your level 1 when you did limiting factors. And then I'll relate it to throughput. Let's assume we've got 3 products. Call them A, B, and C. Now, these products all share common resources, but of course in different quantities, meaning that they use the same amount of material, same amount of labor, and same machine time and all that. Let me rephrase that. They use the same type of material, the same type of labor, and same type of machine, and so forth, not the same amount. Right? So all the resources used, okay, the type of resources used by A are used by B and used by C as well, but they are three different products. Now let's assume that the selling prices, okay, are as follows. Okay, let me just put this in here. Dollar. Sorry. This is what happens when you're using a totally different keyboard. Right. So the selling prices are 50, 40, and 20. And the variable cost made up of, now remember this is the figures I'm using here, and the description is not under throughput, it's under normal limiting factor situation, but I'm using this in order to then carry it across to throughput. So the variable cost, the total variable cost, okay. All right, let's say for this one is, okay, okay. And for this one, it's 25. And for this one, it's 3. 3 might be a bit too low. Let's say 8. Okay. Okay, so that means the contribution would be, contribution per unit would be 20 and 15 and 12. Now these are the contributions, okay, of the units, meaning the sales, that's the total variable cost, again made up of materials, labor, and so on and so forth. Now if the question, okay, was posed, and the question which has been posed is as follows: which of these three products is the most profitable one? Clearly we would say product A, followed by B, followed by C, because product A has the highest contribution, sales less variable cost, followed by B, followed by C. And remember, all other costs are assumed to be fixed. So without any limiting factors whatsoever, if the question, okay, arises which is the most profitable product, it would be A, then B, then C. Now that is like what we read just now, except of course the only variable cost is with materials. When we said on the handout that if, when the company has more capacity in the market demand, the criterion is the product which maximizes the throughput. Sell as much as would increase the contribution. And of course, if you had to go down the line, okay, based on that, product A is given the highest contribution, you'll want to sell as much of A as you can. If you know you can produce 10,000 and sell 10,000, you definitely want to do that, then B and C. But what if, okay, one of the resources employed by the products is scarce and in short supply? So for example, what if the material which is used by each of the product in different amounts, but the material is short, in short supply? Now in that case, we cannot automatically say that A is the most profitable product followed by B followed by C. In that case, what we've got to say is which of those three products makes the best use of the scarce resource. In other words, gives us the highest contribution, okay, from the use of the resource. Now it's very much a situation like this, you know. Again, let's assume that for you, your salary, your cash, then is your limiting factor. Okay. Now, if you had no limiting factor whatsoever, if cash was not a problem, if you're one of these very fortunate people where you can rest assured anytime you stick your card into the ATM machine, you will get money out. And you don't even need to do a budget because you know money is always there. Okay. Then you can buy whatever you want. You don't need to think about restricting, saying, oh, you know what, I have to pay this first, then if I have money, I'll do this, then if I have money remaining, I'll do that. You can do everything. Right. So if the company had no limiting factors, it will produce, all of total demand of all of the products. But as I'm saying, if a material type is scarce and the same material is used by A, B, and C, but in different quantities, what the company wants to do is to produce in such a way so as to make maximum use, the most profitable use of the scarce resource, the material. In your case, therefore, okay, making the most profitable use of the scarce resource would be doing the things that must be done first. And of course, in your household unit, if you're the main breadwinner, what has to be done first is you must buy food. Yeah, you can't pay a bill and starve. I mean, it makes no sense. So you have to buy food. And then, of course, you may try to ration the use of the money as best as you see it. If you had no cash flow problems, you would just pay everything in one go. With the business here, okay, therefore, the business cannot simply rely on the concept of contribution, but see which of these three products is making the best use, the most profitable use of the material, which is assumed to be the scarce resource here. Now, let's assume that I'll write here material, okay, per unit, right? And it's in kilograms. Let's extend this a little bit. And I'll put 5. And I'll put 3. And I'll put 2. So 1 unit of A needs 5 kilograms of scarce material. 1 unit of B needs 3. 1 unit of C needs 2. And we need to determine which of those three products is making the most profitable use of the material because it is scarce. And remember, again, keep thinking about your situation with your cash. You want to do the most profitable thing, so to speak, first, which, in your case, the thing which has to be done first then. So what we will do is we would calculate something called contribution per unit of the scarce resource. Contribution per unit of the scarce resource. Contribution for every kilogram used then. So I'll put here contribution, okay, per kg used. Extend this again. And the way in which we'll calculate that is to divide the contribution by the kgs, the scarce resource. So I'll do it for you. 20 divided by 5. Oh God, I'm gonna have to go and change it. I hate when this happens. forcing me to go and change up everything. Okay. Hang on a bit. Right. Sorry. Divided by 3 and 12 divided by 2. And note, this gives us 4. Okay. And this is $4, by the way. Let me emphasize that. Because remember, it's $20 every divided by 5 kilograms. So it's $4. Okay. So without the limiting factor, the order of priority, okay, would have been 1, 2, and 3. Not that was a problem. We would have produced, remember, as I said, as much as we, is in demand. But if you were asked which is the most profitable product, you'll say A, then B, then C. But in the presence of the limiting factor, the product which makes the optimum use of the scarce resource is the best product here now. And guess what? That becomes E, which previously was seen as the lowest ranked product. And this is a very, very important thing. Because when you did decision making, I hate saying that all the time, but when you did limiting factors in level 1, you would have been taught how to calculate the contribution per unit of limiting factor and do something exactly like this. And of course, again, as I keep saying, we'll have to do it in more detail when we do decision making in level 2. Now, so you will produce as much of C as you can, and whatever is left over in materials, you'll apply to B. And if anything is left over, you'll apply to A. If nothing is left over, you cannot produce any of A. Or if something is left over and the demand for A is 3,000, but you can only produce 1,000, well, so be it. You'll produce 1,000. Now, that is the same concept used with throughput, except with throughput, the only variable cost to remember is material. So we will do the same thing as what was done here, except for variable cost, we will be using material, not material and labor and any other variable cost, only material. And this is how what we just did here is both different and similar to what we will do under, or what has to be done under throughput contributions. When the company has a constraint, the procedure is to find the throughput per unit of constraint, example time, like how just now I said material, and to decide on the optimal product plan. However, when the company has more capacity, as we said, the criterion is simply to maximize throughput. Of course, the situation you will meet when doing a throughput question is this one, when there is a constraint. Whatever the decision being taken, it is necessary to quantify its impact on the company's net profit and ROI. Now, remember I told you just now, and you saw ROI, since investment is material, is throughput less operating expenses divided by investment, because what we're doing is calculating it as a rate, a return. But throughput less operating expenses alone is equal to profit. So throughput less operating expenses, profit then over the investment, is return on investment. And therefore the profit alone, not the return on investment, will be throughput less operating expenses, which again is not difficult if you were to visualize it in your mind. Throughput contribution is total sales less total material cost, or selling price per unit less material cost per unit multiplied by the total units sold. And then when operating expenses are deducted, that's profit. And operating expenses are all the expenses incurred in converting the investment in materials and so forth into a saleable manner, for it to go into the unit, for it to be sold. Now, what this shows you a bit more theory on throughput, and we take a look at it just now. But the calculations to be done are shown in a separate handout, which we'll look at shortly. In fact, let's look at the handout first, since we've been talking about throughput and operating expenses, and for you to see how it relates. Okay. Let me just pull it up here. Okay, I just temporarily pause my share. Right, let me just find this handout for you. Okay, so these are typical of the formula, I'll call them formula, that you need to do in order to carry out calculations. And of course, we'll see it in effect just now. Total throughput, as we saw before, is selling price take away material cost times sales volume. If you simply need throughput contribution for one unit, it will simply be selling price less material cost. Of course, you can also calculate total throughput as total sales minus total material costs. Return on investment, as we saw just now, is throughput minus operating expenses divided by investment. And net profit is throughput minus operating expenses. Now, there's a very important, there are very important further calculations that you need to be aware of as well. The most important calculation really in throughput accounting is something called the throughput accounting ratio, sometimes referred to as TPAR, throughput accounting ratio. Now, before you can calculate the throughput accounting ratio and see what it is, you need to know how to calculate the inputs that go into the calculation of throughput accounting ratio. Because down here, if you were to just take a look, throughput accounting ratio is calculated as return per factory hour over cost per factory hour. So before you can do this, you need to find these individual parts of the formula. So let me just keep this here so you can actually relate what we do into this. The first part, the numerator in the TPAR formula shown here, is throughput return per factory hour is calculated as throughput per unit divided by the time spent on the bottleneck resource. Now, the bottleneck resource is again a term used in throughput accounting, and that is simply the constraint. Remember, bottleneck is a constraint. I mean, if you literally take a bottle which has a narrow neck, the amount that can come through is dependent on the size of the neck. So if it's a really small neck, there's just so much that can come through. If on the other hand, you were to take the liquid in that bottle and transfer it to another bottle, which has a far wider neck, of course, it will come through at a quicker rate. That's the reason why bottleneck is normally applied to traffic situations, where there might be 4 lanes of a highway, okay, and there's no problem whatsoever. They're all flowing down and down and down and down at a very fast rate. And then suddenly the 4 lanes turn into 2, and it creates a bottleneck. The bottleneck is the constraint. Now, I told you before, as you saw with theory of constraints and the chain reference, trying to strengthen any other link in the chain without trying to do something about the weak link makes no sense. So when faced with a bottleneck under a traffic situation, putting in a further 5th lane and 6th lane and leaving the 2 lanes in which they divert makes no sense. It's just going to increase the problem, isn't it? So in that case, what you need to do is to sort out the bottleneck. Perhaps widen the bottleneck so as to allow more to go through us with the water. So bottleneck and constraint, same thing. To calculate the throughput return per factory hour, and you'll see why we need to calculate it per factory hour. Shortly, we take the throughput per unit, found in the usual way, sales minus material cost, and we divide it by the product time on the bottleneck resource. So if, for example, okay, and here we are assuming that, say, machine time could be a bottleneck resource, by the way. If every unit spends 2 hours on the machine, then we'll divide it by 2. And that would give us the top part of the formula. Now think about this for a minute. Let's assume that the throughput per unit is sales less material cost is $20, and the time spent on the bottleneck resource is 4 hours. 20 divided by 4 is 5. On the other hand, if it's 5 hours, 20 divided by 5 is 4. If it's 10 hours, 20 divided by 10 is 2. So the throughput for factory hour is the throughput per unit contribution divided by the time spent on the bottleneck resource. Now we'll see where this is headed in a couple of minutes. The denominator in the TPAR formula is cost per factory hour. And that is calculated as total factory costs divided by total time available on the bottleneck resource. So the total factory cost is 50,000 and the total time available on the bottleneck resource is 20,000. Okay, say hours. We divide the numerator by the denominator and get 2.5. The total factory cost is simply the operating expenses. Remember, we saw operating expenses on the handout, and I told you this would be all fixed costs. All those other costs are assumed to be fixed, labor and any other overheads, production overheads, and so forth. So the total factory cost, and again, therein lies the reason why students doing this on their own may be confused, because these terms, as I keep saying, have specific meanings. Total factory cost is the operating expenses, which are all the fixed production costs. The TPAR is the first one divided by the second. Now, let's check this out. Note, the total factory cost, as we just said, is fixed production including labor. The total factory cost may be referred to as operating expenses, as we, just explained this to you. Interpretation of TPAR. Now, again, you will see this when we do calculations in a couple of minutes. Why this is so, what we are going to read now. You need to know how to interpret the throughput accounting ratio. The examiner will ask you not simply to calculate it, or what does it mean. If TPAR is greater than 1, meaning, let's say, for example, the return per factory hour, okay, found in this way, is $20. And the cost per factory hour is $10. So the TPAR is 2. If TPAR is greater than 1, this would suggest that throughput exceeds operating costs, which makes sense if you look at the formula literally. So the product should make a profit. Priority should be given to products generating the best ratios. Remember, as you saw just now in the example I used on the spreadsheet, although that related to total variable cost being different, material, labor, and so forth, here the variable cost is only material. In a typical exam question, you may have 3 products, just as how I had A, B, and C. except that all the calculations would be related to throughput-based calculations and definitions. So what we are seeing here is if TPAR is greater than 1, and if the company has some limiting factor, some constraint factor, and it produces 3 products, priority should be given to the product which generates the best ratio. Because if, for example, we divide 20 by 10, we get 2. And another product also has a return per factory hour of 20. Sorry, or has a return per factory hour of say 15, and the same cost per factory hour applies, 10. 15 divided by 10 is 1.5. Now clearly the one which has a return of 20, okay, would be preferred to the one which has a return of 1.5. If on the other hand, now all products which have TPARs greater than 1 are profitable products, but of course you will, where there is a constraint, you will need to prioritize them, just as how we prioritize them in the spreadsheet example. But in the spreadsheet example, let's assume a product had a negative contribution. Let's assume the variable cost of A was 60. 50 take away 60 is negative 10. Since variable costs are all variable, meaning that you must incur them as long as you decide to produce a unit, the general rule is if a product is making a negative contribution, it makes no sense producing that product. No, that's the general rule. I mean, there might be other reasons why we may still continue to produce the product. For example, the product might be complementary and so forth. But on its own, 50 take away 60, negative 10, everything here is cash flow. We are earning $50 for every unit sold. We are incurring $60 in cost for every unit produced of A, and therefore negative, which would normally imply we shouldn't produce the unit. Now, here, if TPAR is less than 1, it would suggest throughput is insufficient to cover operating costs, resulting in a loss. And that's what we are saying. It's, similar to what we looked at with contribution, except here, throughput contribution, as I keep saying, is sales less material cost only. Now, let's take a look at an example first, and then we'll go back to the reading part and the handout. The only reason I'm doing it like this is because as we are in example mode, as we are in calculation mode, and so to speak, and also as these things are new to you. Now, there are a few questions here. Right, we'll be looking at one of them only. I'll send the rest. In fact, I wouldn't send the rest. What I'll need you to do, as I have done in the past, I don't usually ask you a whole bunch of questions immediately following the discussion, because normally, being realistic, a student needs time to go through this stuff a bit. And that's why you'd find that typically I would do a question on the topic in the following lecture. But in order to show you how these calculations work, we would take a look at this simple question here. The questions which we'll be doing next day, one is a longer form question, and a few of them are objective test question format. So you'll see exactly how it can be examined all over the place and in different ways. Let's take a look at this question here, and we'll go through the calculations together, since, as I said, it's the first time that you're seeing it. Growler manufactures computer components. Health and safety regulations mean that one of its processors can only be operated 8 hours a day. So we assume that process is the constraint. The hourly capacity of this process is 500 units per hour. So 500 units can be produced in 1 hour. Okay. The selling price of each component is $100, material cost 40, which means right away the throughput contribution per unit is $60. The daily total of all factory costs, conversion costs, remember that as you saw in the handout, would be all the operating expenses, which are assumed to be fixed, the labor and the overheads and so forth. The daily total of all factory costs is $144,000, excluding materials. Now, a question didn't have to tell you that, meaning excluding materials. If this question had simply said the daily total of all factory costs, conversion costs, is 144. Based on what we've been reading in the handouts about the conversion costs or the operating expenses costs incurred to convert the raw materials, into the final product, it has to be excluding the materials. Expected production is 3,600 units per day. Required, calculate total profit per day, return per factory hour, throughput accounting ratio. Now, we will simply be using the formula that we looked at just now. Cost per factory hour, throughput return per factory hour, throughput accounting ratio. Okay. All right. Let me see something here. To make it easy, let me see if I could get us to copy nicely and paste. It didn't come out too nice, but we can fix that. Right. Actually, I shouldn't put them here. I should put them here. Which is where I've got it worked out for you. And then the second one, I'm just laying down the formula here. They're not necessarily in order here. It's just so that, because the best way, I'll tell you something. When you are doing these things for the first time, look at the formula. You see, you will the only way that you'll get used to using the formula is if you were to come back to the same thing actually. Yeah, is if you were to see the formula in action. In other words, then, by all means, and this applies to other things we're doing as well. For example, when we look at variances, the only way that you'll get used to the calculations is to look at the formula necessary to calculate certain variances as you are doing your practice questions, as with anything. So you are both revising and doing at the same time. See, learning is a technique, You can have all the knowledge stuck up in your head, but if you can't apply it, okay, you're not going to go very far. And I think that's a problem that students run into. Applying it means doing practice questions and going through the topics, the material, right after it's done. And remember that study plan I keep telling you about, or which I told you about, and I keep emphasizing about you study your first 3 topics sequentially, and then at the end of the third, go back over the first 3. Then you study the next 3 sequentially, 4, 5, and 6. And at the end of the 6, you go back quickly over the first 6. And, those little study tips would ensure that you're always up to date in your work. Anyway, let's take a look here. First thing the question wanted us to do was to calculate the total profit per day. Now that's not difficult because, we will take the contribution minus all the costs, the operating expenses, as we saw in the formula, okay, on the handout, the same handout, but higher up at the start. When I say the same handout, the handout with the formula. So in this example, remember the company is 3,600 units a day being sold. The selling price is 100, the material cost is 40. So the contribution is 36 times 60. And of course, the conversion cost, which I all assume to be fixed, is 144,000. So the profit per day is 72,000. That's easy enough. Return per factory hour. Now, watch this here. Remember, the return per factory hour is throughput per unit divided by product time on the bottleneck resource. And you've been asked to calculate return per factory hour. Now, follow me on this explanation here. This return per factory hour, that's what we are calculating. Each product, we are doing this on a unit basis, a product basis, a single product basis. Each product has a selling price of $100 and has a variable cost material of $40, which means each product has a throughput contribution of $60. And remember, okay, return per factory hour is throughput per unit, which selling price takeaway is 100 takeaway 40, 60, divided by the product time on the bottleneck resource. Now, watch this. You were told 500 units can be produced in 1 hour. But we need to do this on a unit basis. We cannot divide this by 500 because that's 500 units. We need to find out the time taken to produce the bottleneck time then taken to produce 1 unit. Now 500 units are produced in 1 hour. We need for 1 unit. So to find the bottleneck time taken for 1 unit, because remember the numerator is for 1 unit, this is for 1 unit, we need to say 1 divided by 500. See, it's like saying 500 units is 1 hour. So 1 unit is 1 over 500. Simple proportion calculation. Now, quite a lot of students would have mistakenly just divided this by 500 because they didn't stop to think and look at the question. We are working on a unit basis here. 100 is 100 per unit. 40 is 40 per unit. That's per unit. And therefore, dividing this by 500 would be wrong because 500 means 500 units. We need to find the time taken on the scarce resource by 1 unit. And as I said, it's as though we're saying, well, 500 units take 1 hour, so 1 unit will take 1 over 500. A small figure, but that's how it is. When we divide 60 by 1 over 500, it comes to $30,000. So the return per factory hour, therefore, okay, is $30,000. Now watch this. You would then ask to calculate the throughput accounting ratio. Now remember, we are dealing with 1 unit type. If this company produced 3 unit types, just to show you, each unit type may have a different throughput contribution. The next product, for example, say type B, would have been the selling price maybe would be 120 and the conversion cost may be 70. And we will do the same calculation if we had to rank the 3 products. Now, of course, we'll do a question like that, but as I said, you need to go through the principle and whatnot first, and that's a question like that we'll do the next day. And you will arrive at a different total figure instead of 72,000. So we are dealing with this particular product type. The throughput accounting ratio, therefore, return per factory hour, which you saw is 30,000. divided by the total conversion cost per factory hour. Now, what some students again would have mistakenly done, let's say they had got past here, is just divide 30,000 by 144, saying, well, that's the conversion cost. But that's the daily conversion cost in total, 144. You need the conversion cost for 1 hour. And there are 8 operating hours a day. So 144 divided by 8 is whatever it comes to. And 30 divided by that figure gives 1.67, which is the throughput accounting ratio. Now, in this example, we are assuming that this is what the company produces. You know, meaning like maybe whatever product type this is. But as I said, in a typical exam question, you may be given 3 products. And exactly what we did here, you need to do it for the 3 products. Because you may need to calculate throughput accounting ratio for each product. And the one which has the highest throughput accounting ratio is the best one. Now you saw the explanation for the throughput accounting ratio being greater than 1, less than 1. Less than 1 makes a loss. More than 1 is good. But if all products are making more than 1 and there is a constraint, the most profitable product would be the one with the highest TPAR, which is similar when there's a limiting factor. The most profitable product would be one with the highest contribution per unit of the limiting factor. Now, the 6 continuous steps to obtain the goal. Maximizing throughput involves the following 5 continuous steps. 5? 6 here. Oh, it's actually 6. Hold on a second. Yeah, I know why I wrote 5 here, because number 6 involves starting over. But leave it as 5. You'll see why. Maximizing throughput involves the following 5 continuous steps. Firstly, and this is actually what we've been doing, this is just the procedure really. Identify the company's most binding constraint, the factor which places the greatest limitation on increasing throughput. The constraint could be internal or external, meaning it could be, if for example we use outsourced labor supply and it's in short supply, it could be external to the company, or internal if we are producing our own type, it may be a machine type. The examiner will usually make it quite, in fact not will usually, the examiner will make it quite clear, okay, which is the constraint. For example, external may include weak customer demand, a distribution bottleneck, or a shortage of a material type. Or as I said, it could be a labor type as well if we outsource the labor part of it. Internal may be a bottleneck constraint, example, labor hour limitation. You will normally be dealing with an internal bottleneck, like what we saw just now in the example. Exploit the internal constraints by maximizing the flow of work through the constraint. This is similar to maximizing the contribution per unit of the limiting factor. In this case, maximizing the throughput per hour of the limiting factor. So exploit the internal constraint by maximizing the flow of work through the constraint. The bottleneck constraint should never be left idle, because an hour lost at the bottleneck is an hour lost for the entire system. That's right. Now this makes sense, because if we go back, well, you can use any other examples we've been using. If we go back to employee number 5, the one who is, causing the problem because he's working way behind time, very slow and whatnot, and he's not working up to par. You don't wish to waste an hour from the constraint, because the constraint is already behind time, as with the employee then. So it's similar to the materials. If materials are in short supply, okay, you don't want to waste the materials. If machine time is in short supply, the constraint, you don't want to waste machine time. That's why you told the bottleneck constraint should never be left idle, because an hour lost at the bottleneck is an hour lost for the entire system. External constraints such as demand are exploited by advertising, market promotion, etc. Number 3, subordinate and synchronize the other internal constraints with the most binding constraint. This is to keep them working at the pace of the most binding constraint. But what we're saying there is this: it has to do with the chain example, or it has to do, even better, let me use the example of the traffic bottleneck. The 5 lanes eventually end up into 2. What that means is that at some point the 5 lanes have to work at the pace of the 2. In other words, then, if material is in short supply and everything else is freely available, okay, the amount of labor output and machine output and anything else that goes on is dependent on the amount of the scarce resource available, material type. Or again, if we use the example of the 4 employees and the one who is working behind time. The 4 employees have to cut their output to work in line with the 5th one. Because if the 4 employees go ahead and do as much as they like and as much as they can do, and the 5th employee, as we use in our example, is always behind time, then that would create additional stocks or additional work which cannot be completed, additional effort which will come to naught because it cannot be completed. So everything has to work at the pace of the weak one. Now, of course, I am not saying that we will leave it like that. Remember, I told you what the company would look for, as you would see here in step 4, is to try and do something about it. But as long as it exists, it is important to work at the pace of the most binding one in order to avoid wasted resources and time and effort. Another way to express this idea is to say that the utilization of a non-bottleneck operation or resource should not be determined by its own capacity, but by the capacity of the most binding constraint. Recognize the ideas above in developing performance measurement systems. The performance measurement should emphasize the efficiency and effectiveness of the total operation or total system, not the efficiency of the individual operations, since the goal is to maximize throughput. Oh, sorry, I said it would be seen in 4. It's actually seen in 5. That is how we will try to deal with the binding. Step 5 says increase the capacity of the most binding constrained resource. Now, a good question, although it's been stated just as one line, a good question is how? How do we increase the capacity of the most constrained, the binding resource? Clearly, we need to do something about it. The company cannot continue like this, because total output of the company can be greatly increased if we can do something about the binding resource, the binding constraint. Right now, let's say the other 4 employees, let's say, can produce up to the equivalent of 1,000 units a week. But because of the 5th employee, they cannot produce 1,000 units a week. They can only produce 300 units a week, because that is what the weak link can produce. And remember, they're working as a team. So clearly, that's a suboptimal situation. And clearly something needs to be done. What can we do in that case? Well, I mentioned it in passing. Get the weak employee to try and step up. And if the weak employee cannot step up, we may need to get rid of him or transfer him to another part of the organization. And therefore replace him with an employee who can step up. In the case of, let's say, the binding constraint is a machine. So right now, the machine can only give us 200 hours a week. But we have enough capacity and other things to produce up to 1,000 units a week. And there is a demand for the 1,000 units. What we may need to do is to replace the machine with one. Maybe the capacity of the machine is low. So replace it with one, okay, which can give us what we want. Or before we replace it, which would cause for huge capital expenditure, try to see if we can increase the current throughput of the machine, the amount of units produced of the machine, in whatever way. If that's not possible, we may have no choice but to replace the machine, as I said, which would call for capital expenditure. Or if there is no machine available, what we may have to do is to continue working with the existing machine, but outsource that particular necessary input. In other words, what that machine is doing, okay, the input, if we can outsource that part of it. Doing something about the binding constraint in practice would usually call for additional expense on the company's part. And the additional expense can be quite high because, as I said, it may actually involve replacing the machine with a more efficient one, or buying an additional machine, but it would usually involve some sort of a capital expenditure. And then number 6, which is why 6 was not considered as an actual step, identify the new most binding constraint, start over. See, guess what might happen? After we solve the existing problem, meaning the problem of the existing binding constraint, we may find that a new binding constraint develops. Because things are never perfect in the life of a business. Things always come up. Materials, for example, which are all available now, and the problem is a machine type. We've solved the problem of the machine type, and suddenly we find the material availability now is causing a problem. And then we've solved that now, and then we find labor, type of labor is causing a problem. So, it's never perfect in the business world. And that's why number 6 is to identify the new most and start over again. So this is what throughput accounting is about. And what I did in this session is introduce you to the terms, the formula, the little formula explaining the different terms. Okay. And we did a very small example just showing you how to apply the ratios. What you need to do before the next class is to go through the handout in detail, because no doubt, as you would have seen for yourself, doing this thing for the first time is not the easiest topic to understand, because it has its own rules, its own definitions, its own meanings. So you need to go through that, and you need to go through the example, the small example that we did, which of course I'll send for you with the solution. And in the next class, before we get on into the teaching part of it, we'll do a question or a couple of objective test questions, and maybe a longer form question on throughput, and get that out of the way. And then we'll get on to the teaching part of the next class. So that should give you enough time to, at least do some work on it. What I'll also do when I'm sending the handout with the worked out solution is I'll send some other worked out illustrations for you. So at least you can have some additional stuff to see how this throughput thing works. So you'll be in a good position, okay, to attempt an exam standard question on Throughput when we meet, in the next class, okay. And I now remember I told you at the start of today's class that we have some makeup classes to do, and the first one would be on Monday, because I told you you'll be using Monday to do the makeups. I told you also that would just be for a few Mondays, but our normal class will continue to be on Saturday. So it wouldn't be all the Mondays from now until the end. It's just a few Mondays. But for Monday's class, I may not necessarily do the exam side question, because you may still need some time to go through what I'm going to send for you, the additional illustrations. Okay. So that will give you enough time to go through. Between now and Monday, which is just a day or so, might be a little bit rushed. So the exam question I'm telling you about and the exam standards will be next week, Saturday. What we'll be doing on Monday is simply continuing with what we are going to start now, which is decision making. Now, I'll tell you how decision making fits into your syllabus just now. But what you realize as we get on into decision making, some of the concepts we've been talking about here are discussed in decision making. For example, the concept of a limiting factor situation. That is a decision making situation. So we're going to make a start on that now, which is another topic. And we'll continue with this topic on Monday, because it's quite a big topic. And the exam standard questions, which I've been talking about on Throughput, we look at next week, Saturday, because you would have had enough time to go through the handout, the spreadsheet with some additional illustrations, and get yourself all ready. Okay, let me just pull up something here. And whilst I do that, I'll just temporarily, pause the share, because I need to show you how, and I'll also temporarily pause the recording. Okay, good. All right. So, although the screen was paused for a few minutes, I thought I had unpaused it. Okay. But at least I was explaining certain things here in relation to the syllabus, so you should at least, it wouldn't have made that great a difference, the fact that the screen was paused. But what we are going to look at now gets on into this big key area called decision making. And part of decision making is understanding the concept of relevant costing. Now, when we looked at marginal costing, we saw that marginal costing is not congruent with the standard for reporting. In other words, then, when looking at IAS 2 inventories, we saw that stocks must be valued, including a share of all costs involved in bringing the product to its current location and condition. So if a company manufactures a product according to IAS 2, which deals with inventories, absorption costing should be used, because absorption costing includes fixed production overheads, and fixed production overheads do go into manufacturing a product. But we said, and indeed this would have been covered when we looked at the advantages and disadvantages of absorption and marginal costing. We saw that marginal costing, though, is better for decision making. And you should know that, because apart from discussing it, remember we looked at a couple of videos that showed, the differences between the two, marginal costing and absorption. And in the video presentation also, it would have been emphasized that one of the strong points, or the main strong point of marginal costing, is that it should be used in making decision situations. So when looking at decision making, this is largely an internal thing for the company. The type of decision making situations and the type of decisions involved, are decisions to be made by management. And these decisions are very important. An example of a decision is a limiting factor situation, which we spoke about a few minutes ago. The company has a scarce resource, say a material type, and this material is used in the production of 3 different product types, A, B, and C. Ordinarily, product A might be the most profitable product. Ordinarily, product A might be the most profitable product. But because there is a limitation in the available amount of raw materials or whatever, suddenly C becomes the most profitable product. A decision has to be made then, okay, how should we go about formulating our production plan? Now, in this case, the decision should be to produce as much of C and then B, if anything remains, and then A. However, although that is the optimum or the optimal production plan in order to maximize profits, when and only when there is a scarce resource, because I keep saying if there's no scarce resource, we should follow ABC. So although that is the optimal plan, there may be other factors to be considered before a final decision is made. For example, what if A, B, and C are all complementary? In other words, okay, consumers would only buy the products if they can get all of the products from the company. So maybe, okay, it's 1, 1, and 1. Every time a A is purchased, they would purchase a B and they would purchase a C. Now, in that case, following a production plan, which would suggest produce as much as C first and then B and then A, is not a feasible one anymore. And you have to know, I'm just giving you an overview, how to work with a situation like that. And all those things are involved, okay, on the decision making. Let me give you another example. There is a certain decision making situation, okay, called make or buy. And in that decision making situation, okay, the company has to decide whether a component part should be made internally or outsourced and bought from outside. We are not talking there about the product that the company sells. We are talking about a part which is used in producing the product. Maybe right now, the part, let's say the company is producing computers and desktop computers. Now, a part which is necessary is the keyboard. But it just so happens that right now to produce the keyboards, okay, it costs the company too much. So the company is currently evaluating, should we continue to make the keyboards internally or instead buy it from outside? Now that's an example of a make or buy situation. Another type of decision situation is a closure decision, also known as a cessation decision, where the company, okay, right now produces 3 different products. And one of the products right now, say product C, is making a loss. In other words, the contribution is negative, so it's a negative contribution. And management is trying to decide whether we should continue producing product C and run it at a loss or stop making product C. Now that's an example of a closure decision, because closure there, although the term closure would usually apply to a physical space like a department or so forth, or an outlet, it is directly related to the product itself. So if the product is stopped, that's the reason why we use the term cessation as well. Cessation as in cease. Then we may have to close down the relevant department. So that's an example of a cessation decision. Should we continue? Now you might be saying to yourself, but some of these things are fairly clear cut. I mean, if the product is making a negative contribution, clearly we should stop it. It's not that easy. Because what if, again, the products are complementary products? And customers would only buy A if they can get B, if they can get C, but C happens right now, okay, to be generating a negative contribution. Then what management has to consider is the bigger picture. What is going to be effect on the company if we were to stop C? And I'll have, again, those things I will show you. How do we evaluate a situation like that? So you see, decision making, and those are just three key decisions. There are others as well. Decision making involves a number of things. It involves, for one, evaluating specific decision, okay, type situations, as I just explained. It involves limiting factors as one of the decision, but here we saw there is only one limiting factor. You may have to deal with two limiting factors or three limiting factors. And of course, in order to deal with that, you cannot use this simple approach. You have to use something called linear programming, whereas you, as I explained, you need to maybe draw graphs and so forth. So it's, quite a big area, very big area. Now, at the heart of decision making, which means regardless of what type of situation that we are looking at, whether it's make or buy or limited factor or cessation, okay, or any of the other types which we look at the heart of it all, and really the starting point, is the concept of relevant costing. Relevant costing and decision making are directly connected. A decision cannot be made unless relevant costing concepts have been applied to that decision situation. So you need to know first and foremost, what is a relevant cost? What makes a cost a relevant cost? Because in making a decision, only relevant costs are to be considered. Costs which are irrelevant or non-relevant costs should not affect the decision. Now, you may recall the term sunk cost from your earlier studies, SUNK. Let me give you an example of a cost which is non-relevant as opposed to a cost which is relevant. Of course, I will show you the guidelines used to determine whether a course is relevant or non-relevant. But, just to give you a quick example, let's assume that a company, okay, is contemplating making a new product, okay. Now, the company is trying to identify the relevant costs and the non-relevant costs associated with that decision, because the decision is, should we go ahead and make this new product? Furthermore, let's assume that the company has spent $100,000 in a feasibility study, on the background of the product, then, market research and all sorts of things. Now, that has been spent already. And remember, the company is trying to decide whether it should make this product or not. Using relevant costing concepts, that $100,000 which has been spent already would be referred to as a sunk cost. And that should not affect the decision as to whether the product should be made or not. The reason being, because whether or not we decide to go ahead and make the product, the $100,000 which has been spent already cannot be recovered. It's gone. It's sunk, as it's, the term which is used. The only costs which would be relevant are cash costs to be incurred in future. Any cash cost which was incurred in the past is historic or sunk and should not affect the decision. Now, right away, you'll probably see in how different the concept of relevant costing is. Because you may be saying, but clearly that's not so. We need to recover that 100,000. And I am not saying that you are wrong. What I am telling you is, when applying the concept of relevant costing and decision making, any cost which has been incurred already is not to be included in the decision, because the quality of a relevant cost, the two qualities are: one, it must give rise to cash flow implications, and two, it must be affected by the decision to be made. Not one or the other, but both of them. And when those two conditions or qualities are applied, certain costs which we in the normal course of things would consider to be relevant would actually be non-relevant. Let me leave you with one last example, not related to a business situation, but related to your personal situation, because often I would use these examples related to an individual, because if you can understand that, clearly you should be able to understand what we are saying. And this example will show you how different the concept of relevant costing is, which is why students tend to have problems at the beginning with it, unless they can relate to these main principles. Let's assume, okay, that you've signed up for your exams, okay, for June. Right now, I'm just using a hypothetical situation, and you cannot recover those exam fees. You paid them already, and let's assume there is no chance of you getting them back. Right, you paid them. Now you are trying to decide today whether you should actually write the exams in June. Sorry, September. June exams are gone, right? So everything I've said so far is September. I don't know why. I think I'm thinking of June because I told you I had these 1 or 2 revision courses for June exams. So it's in your case then, because you are writing exams September. So let's assume you've paid your fees for exams in September already, just assuming, okay? But you trying to decide, maybe for whatever reason you have in second thought, should I actually go ahead and write these exams in September? And under maybe, okay, somebody might say, but you have to go and write the exams. You pay the fees. If you don't write the exams, the fees will be wasted. And of course, logically, I mean, that does make sense. But guess what? Using a relevant costing concept approach, if your decision is should I or should I not write that exam in September, and if you had paid those exam fees already, those exam fees, the cost of that is a non-relevant course. It's a sunk course. Because the way using a relevant costing concept approach, the way you would think about it is this. If I have to write the exams in September, will that change the cost I have incurred already in paying for the exam? If I do not write the exam in September, will that change the cost which I have incurred in paying the exam fees? And the answer is no. Whether you decide to write the exams or not, the exam fee has been paid already. And therefore, the cost incurred in that exam fee is a non-relevant cost, it's a sunk cost as far as your decision to write the exam. Now, again, we are assuming here you cannot get it back. So what type of cost would be relevant to that? Well, all the costs in relation to that which have not yet been incurred. For example, okay, let's assume that to get to the exam, or let's assume that if you have to write the exam in September, okay, you're going to have to take time off. And I'm just using an example here. And your boss says, look, if you take the time off, I'm not going to pay you for that day. Maybe you got a mean boss, right? And he says, if you're going to take the time off to go and write your exams, I'm not going to pay you. In fact, you're going to lose that. He's going to dock money from your pay. And let's assume the amount will be $500. That is a relevant cost. Because if you decide to write the exams in September, you're going to lose that. If you decide not to write the exam in September, you wouldn't lose it. That is a relevant cost. Or let's assume that to get to the exam, you have to hire a taxi to take you because you're one of these people, you don't like to drive yourself to the exam the day you're a little bit nervous and so forth. And to pay that taxi will be $500 to take you and bring you back. that will be a relevant course because it's a cash flow course and it will be affected by the decision. If you decide to write the exam, you have to incur it and pay the money. If you decide not to write the exam, you will not hire the taxi and not pay the money. And that is what a relevant course is about. It must always have two qualities and it will affect. Relevant costing, as I said, must be used in any decision situation that you will encounter because relevant costing is at the heart of decision making. And on Monday, okay, having given you that brief introduction, we'll get on, start off by looking at the concept of relevant. How do we know what a relevant course is? Looking at some of these situations and whatnot. And of course, having introduced you, having got through the theory bit, we will then proceed to evaluate the different type of relevant costing situations. And of course, I will always link it back to the syllabus so you'll see exactly where it fits into the syllabus. Okay? So what you can expect today, when I send you the recording, I'll send you the handout, of course, that we use today. I told you that I'll be sending you these handouts, at the end of the class. And I'll also include some additional illustrations on the worksheet, the one where we looked at the question with Growler, so you can actually see how this thing applies. And next week, Saturday, we'll work out some short objective type questions and a longer form question on Throughput. But on Monday, which of course is our first makeup, we'll be continuing with decision making. Okay? Now again, just to emphasize, the makeups will just be a few Mondays because remember, it's just to make up what we would have lost. And if we can make it up before, meaning let's say, for example, we have to put in 3 sessions, we'll only have to put in 2. But, I will do what has to be done. So you don't need to worry about that. But, it will just be a little inconvenience for you for a few Mondays extra class. I know it's a little bit hard, but, the course is a big course. You see, before we go, I'll tell you something. The performance management courses I told you in level 2, I still refer to level 1, 2, and 3, right? So, after the auditing course, I told you, the auditing paper audit and assurance this course has the second lowest pass rate. And one reason for that is it's a very detailed course. And it's not a course that a student should attempt on his own. If you ask any student who self-study, okay, what is the course that tends to give them the most problems, they may actually say, although this has this second lowest pass rate after auditing, they may actually say this paper. And it's like that. I mean, it has concepts that need to be explained. So that's it for today. Okay, we'll meet on Monday as usual, the usual Monday night time, 7. And so look out for the material later this evening. And have a good rest of the weekend. Okay, and take care. And we'll meet up on Monday night. So good day to all.